Picture this, it's January 31st and with just one word, Burry rocks the investor world. Sell. No explanations, no context. It left you puzzled along with seasoned investors. But guess what? It turned out to be famously wrong. The market surged after his tweet, leaving us scratching our heads. Now, let's fast forward. Burry seems to backtrack tweeting. I was wrong to say sell, but as always, his messages lack clarity, leaving us puzzled. We've got two possible interpretations. One, Burry is wildly bullish, expecting stock prices to skyrocket. Two, he believes the market is irrational, and this could result in a market crash. So, what could be the truth behind Burry's words? You should stick around till the end as we uncover the mysteries of his market sentiment. Let's dive in. If you haven't heard of Michael Burry, let me introduce him to you. Michael Burry is a renowned figure in the finance world, known for founding Scion Asset Management and earning a solid reputation for his accurate forecasts. What sets Burry apart is his meticulous research and unique investment strategies, which have consistently proven successful. Investors value his insights because they provide them with a competitive edge when making their own investment decisions. One of Burry's most impressive predictions was his anticipation of the 2008 subprime mortgage crisis. He recognized the warning signs and made bold moves that paid off immensely. His story even made it to the big screen in the movie The Big Short, showcasing his foresight and ability to navigate turbulent times. When Burry speaks or tweets, it's essential to pay attention. His words carry weight and have the power to influence market sentiment, potentially triggering significant market movement. This is precisely why people eagerly await his next move, hoping to gain valuable insights that could lead to profitable opportunities. Now, let's understand Burry's recent tweet. The most plausible interpretation is that he believes the market is irrational. Here's why. Alongside his "I was wrong to say sell" tweet, he shared a chart displaying the stock market's returns following a down day. The data shows that the returns after a negative day are currently higher than any other point in history. Burry believes that there's a wave of irrational exuberance among investors who are keen on buying the dip. This speculative trading behavior is causing wild fluctuations in financial markets that might not be rational but driven by emotion. As a result, the market's exuberance and bubble-like conditions could persist longer than what rational expectations dictate. Burry's point is that trying to time the market becomes a challenging thing in such circumstances. This is why he admits he was wrong to say sell, because the market is exhibiting a slightly irrational behavior. However, it's possible he's a little bit less bearish about financial markets than he previously was. So, is Michael Burry less bearish about financial markets now? That's the question we need to explore by considering different economic scenarios. Now, stick with us. The first economic scenario will be referred to as the perfect scenario. In this case, the Federal Reserve pauses or reduces rates, not due to a recession or market crash, but because disinflationary forces allow for a decrease in the rate hike trajectory. The banking crisis, with Silicon Valley Bank and Signature Bank being affected, as well as issues with European banks like Credit Suisse and UBS, might contribute to the Federal Reserve's decision to hike rates by slightly less. This scenario is known as the Goldilocks scenario, which suggests rates remain stable or even paused at the current level, avoiding an economic downturn. Listen to this. On the other hand, we have two less positive scenarios. One is the BlackRock scenario, where the economy continues to boom, leading to inflationary pressures and necessitating ongoing rate hikes by the Federal Reserve. This could potentially result in a significant decline or market crash in the future. Now, we've talked about the Goldilocks and BlackRock scenario. The last alternative scenario occurs when the Federal Reserve pauses rate hikes due to an economic recession. Previously, BlackRock indicated that rates might remain higher than ideal and cautioned against over-tightening. However, recent developments in the economy have changed this outlook. Following the latest Federal Reserve meeting, Jerome Powell signaled a shift in approach and adopted a wait-and-see stance. To further understand Burry's perspective, let's examine some of his related tweets. During the banking crisis, Michael Burry had mixed opinions. He initially tweeted about a possible Enron in reference to Silicon Valley Bank's troubles. However, it became evident that Silicon Valley Bank was not involved in massive accounting fraud like Enron. Instead, it seemed to be a case of mismanagement and incompetence. The bank faced challenges due to concentrated and loose deposits being withdrawn simultaneously because of economic conditions. Additionally, a bank run occurred due to the interconnected deposit base, contributing to the decline. Burry then hinted at finding our WorldCom and mentioned ongoing legal scandals at Credit Suisse. He further observed a recurring pattern where people driven by hubris and greed take foolish risks and fail. He noted that money printing has been widespread due to its perceived effectiveness. He believes that exuberance in the market might be temporary, indicating that it could be somewhat inflated. However, Burry slightly toned down his negative rhetoric, stating that the crisis could resolve quickly and that he doesn't see imminent danger. He referenced the 1987 Knickerbocker Trust failure, where panic spread but eventually subsided after interventions from entities like the Federal Reserve, Treasury, and FDIC. Burry mentioned that JP Morgan also played a role in mitigating the crisis by assisting the First Republic. This suggests that the banking crisis might be somewhat mitigated. It implies that while the banking crisis may have reached a bottom, it doesn't necessarily address the broader fundamentals of the economy. Two factors could drive down the markets: inherent weakness and the potential exacerbation caused by the banking crisis. My interpretation of Burry's tweets is that he is not solely focused on the banking crisis, as part of it has been resolved. However, negative market conditions could still impact the overall situation. So it's also important to consider the actions of the Federal Reserve, which may hike rates by a smaller increment than anticipated, and adopt a more cautious approach to future hikes. When we consider all of this, we see that Burry has maintained a bearish outlook, although it has become slightly less negative due to the Federal Reserve's less aggressive stance on rate hikes. The catalyst for this shift appears to be the banking crisis, which compelled the Federal Reserve to take a step back. In light of this, Burry's tweets suggest that he views the market as irrational to some extent, but less bearish than before due to the Federal Reserve's adjusted approach. While the market may still experience a decline, it might not be as catastrophic as previously anticipated. If you've got any thoughts about what Michael Burry is saying here, share in the comments below. Of course, because his tweets are a little bit opaque, a little bit difficult to follow, and they are very much open to interpretation. But otherwise, thanks for watching, and see you in our next video.